The stock market is a financial marketplace where investors buy, sell, and trade shares of publicly listed companies. But it's also a fundamental instrument in our country's economy, with prices going up and down based on how investors project value in different business sectors. When the market's up, so is the economy. When it's down, the economy follows. And when it crashes, well, things tend to get really bad for a lot of people. In this episode, we're looking at 10 of the worst stock market crashes in U.S. history and what caused them. Number 10, the 1957 recession. Starting in August 1957, the U.S. stock market dropped more than 20%, spanning over several months. This recession was caused by a combination of inflationary pressures, high interest rates, and a slowdown in industrial production. This significant market drop resulted in a struggling economy and one of the most severe corrections during the post-World War II era. Number 9, the 1940 recession. The 1940 recession was triggered by the economic impact of the Great Depression, which still lingered. The stock market faced a sharp decline due to a combination of fears about war in Europe and a slow recovery of the U.S. economy. In total, the market dropped about 5.2%, but eventually recovered as the U.S. ramped up its industrial output for World War II. Number 8, the 1962 flash crash. On May 28, 1962, the stock market crashed more than 5% in a single day. The 1962 market crash was triggered by a combination of concerns over the economy, rising interest rates, and fear of a potential recession. The Dow Jones dropped sharply in a single day, marking a dramatic correction in the market. It was one of the biggest one-day declines of the 1960s. Number 7, the dot-com bubble burst. The collapse of the dot-com bubble saw many tech stocks, particularly in the internet and technology sectors, lose their value. On March 10, 2000, the market saw a drop of 7.1% in a single day. The market had been driven by speculative investing in internet companies that lacked profitable business models. After the burst, the market saw a protracted period of losses. Number 6, the 1973-74 stock market crash. Between January 1973 and December 1974, the stock market dropped nearly 45% in value. This bear market was triggered by a combination of factors: the OPEC oil embargo, the Watergate scandal, and high inflation. The market suffered severe losses over a prolonged period, leading to widespread economic stagnation known as stagflation. Number 5, the panic of 1907. In October 1907, the stock market dropped 37% of its value in a single month. The panic of 1907 was a financial panic that led to the collapse of several major banks. The market dropped sharply as a result of a banking crisis caused by a series of bank runs and the failure of major institutions. This panic contributed to the creation of the Financial Reserve System in 1913, which aimed to prevent similar future financial instability. Number 4, Black Monday. The 1987 crash, known as Black Monday, saw one of the most significant one-day percentage declines in U.S. history. It fell 22.6% due to a combination of factors, including computer-driven trading, high inflation, and geopolitical tensions, causing a massive sell-off. Despite the severity of the crash, the market actually recovered relatively quickly. Number 3, COVID-19. As the coronavirus pandemic spread globally, markets plummeted 12.9% in response to uncertainty, lockdowns, and economic shutdowns. Investors feared the pandemic would lead to a global recession. The Dow Jones saw one of its largest one-day drops in history, marking the start of a sharp, rapid bear market that triggered government intervention. Number 2, the 2008 financial crisis. Starting September 29, 2008, the stock market dropped 9% due to subprime mortgage failures and a collapse of major financial institutions, creating a global financial crisis. The Dow Jones Industrial Average dropped nearly 800 points in a single day. The crash triggered a global recession, leading to millions of job losses, a housing market collapse, and a massive government bailout. Number 1, the Great Depression. On October 29, 1929, better known as Black Tuesday, the stock market lost an astronomical amount of value, triggering the Great Depression. On Black Tuesday alone, there was a 12.8% drop in value. Over the course of the entire depression, the stock market plunged nearly 48%. The financial collapse led to a widespread panic and massive losses. It triggered a global economic downturn that lasted for years, with unemployment reaching 25% in the United States. And those are 10 of the worst financial collapses in the US stock market in our nation's history. Are there any other moments you think deserve to be mentioned in this list? Let us know in the comments. And as always, if you like this video, please do us a favor and like, subscribe, and check out these other videos on your screen now.